On April 7th at 5:32 p.m., Donald Trump announced a ceasefire with Iran. And from this announcement, we learned two things. First, Truth Social is the single greatest invention of our generation, and is totally not a useless social media platform. And second, markets don't like uncertainty, because the very next day after the announcement, the markets ripped. The S&P closed up 2.5%, the Nasdaq almost 3%, and the Dow climbed more than 300 points, which marked its best day in almost a year. But it didn't just stop there, because a few weeks later, stocks were back at record highs, even as the ceasefire was actively falling apart in real time. Traditional financial media was calling this a relief rally, but that the markets were celebrating peace. But the truth is, that's not what this was. This was something else entirely. But to understand what actually happened, why markets can be at all-time highs when there's a war going on, you first need to understand what Wall Street looked like going into this. Because there's a lot more to this story than just a relief rally. On February 28th, the US and Israel launched joint airstrikes on Iran. Supreme Leader Ali Khamenei was killed. Then Iran shut down the Strait of Hormuz, and the market had its worst 5-week losing streak in nearly 4 years. The S&P was down nearly 9% by the end of March. And while your retirement account was quietly screaming, there was something else happening underneath the surface. Wall Street was beginning to panic. Hedge funds didn't just start repositioning. They were selling at the fastest pace in 13 years. And that's not a loose estimate. That's hard data. Because Goldman Sachs had a front row seat to the show. They run what's called a prime brokerage desk, which services most of the major hedge funds on Wall Street. Which means they see what these hedge funds are buying, what they're selling, and just how leveraged they are. And according to Goldman's own numbers, Q1 hedge fund selling in North America was the largest since April 2020. Gross leverage was sitting over 300%, near an all-time high. And short exposure to macro ETFs like SPY and QQQ hit the highest level since the pandemic. And then, on March 19th, commodity analyst Rory Johnston said this: if you think about some kind of massive detonation in the oil market supply chain in the Middle East, and there's this shock wave that's kind of moving out. This shock is too large for the system to handle, and it will begin to creak and break the longer this goes on. Just how many barrels per day were those disruptions? You know, the squeeze of 2008. And how big is this in comparison? It's bigger than anything in history. Every analyst I speak with, people I respect, people that are not alarmist, they're all terrified. Let's say the East-West pipeline is maxed. There are no issues at Yanbu. The Houthis don't get involved, etc., etc. In that scenario, with the strait remaining closed, we still need to shed 15 million barrels a day of global demand. And that just means prices, $250, $300 a barrel of Brent. We will hit all-time highs in that scenario, on an inflation-adjusted basis, almost guaranteed. So I do think in that scenario, recession is too light a term. We're talking depressionary. Fast forward 6 weeks later, and this might be the funniest take of the year. We'll come back to why in a second. But at this point, the sentiment on the street was pretty clear. Everyone was bearish. Then, on the evening of April 7th, Trump announced the ceasefire. And when the markets opened the next morning, it was like someone turned Jerome Powell's money printer back on. Because over 400 names in the S&P finished green. 13 stocks printed all-time highs. Brent crude dropped around 13.5%, and WTI crude fell over 16%, marking the biggest single-day decline since April 2020. But here's where the mainstream explanation for all of this starts to break. According to maritime intelligence firm Windward, who utilize AI to cross-reference digital GPS signals with satellite radar and imagery, only 5 outbound carriers were actually detected moving through the strait by midday. That's a roughly 96% decrease in activity, compared to the pre-war baseline of around 130 daily transits through the Strait of Hormuz. So something's not adding up. How can there be a relief rally based on world peace? If there's actually no world peace? Which raises the question, what really moved the markets? And the answer is a good old-fashioned short squeeze. And I can prove it. But for this to make sense, we first need to explain the underlying mechanics of a short squeeze. Because when you short a stock, you're borrowing shares from someone and selling them. You're betting the price drops, so you can buy them back cheaper later, return them, and profit the spread. But if the price goes up instead, you're in trouble, because you still have to return those shares you borrowed, which means you have to buy them back at a higher price than you sold them at. And if the price keeps rising, your losses keep growing. And at some point, your broker may send you a margin call, which means you either add more money to your account or you close the position immediately. And when enough people get margin calls at the same time, they all have to buy back their shares. That buying pushes the price up, which triggers more margin calls, which triggers more buying. And that is a short squeeze. And on April 8th, when macro short exposure was at the highest level since 2020, the squeeze began. But the squeeze was only the first domino to fall. Because once stocks started ripping, the algorithms kicked in. And this is where the CTAs, or commodity trading advisors, enter the story. Oh no, oh no, oh no, oh no, oh no, oh yeah. These are systematic trading firms that run on rules-based models. They don't care about news. They don't care about geopolitics. They just follow trends. When the trend is down, their algorithms say short. When the trend is up, their algorithms say long. It's mechanical trading. Goldman reported that CTAs were sitting on about a $30 billion net short position going into the ceasefire. But the second the S&P crossed certain trigger levels, these models flipped, and they didn't flip to neutral. They flipped to go long. Goldman originally estimated these CTAs would need to buy back around $40 billion of equities to exit their short positions. But the actual number ended up being $86 billion across just 5 trading sessions, which, according to Goldman's records, is a top 5 buying speed print of all time. And then, there was the third domino to fall. The options market. Dealers on the other side of options trades have to stay delta neutral, which means when customers pile into calls, dealers hedge by buying the underlying stock. And Spot Gamma, a leading financial data platform, had flagged a negative gamma regime heading into the ceasefire. That's the regime where dealer hedging flips from stabilizing to pro-cyclical. Price goes up, dealers buy more, price goes up more. You get the point. So, a squeeze, plus a systematic flip, plus dealer hedging, 3 dominoes, all falling one after another. That's the rally. That's what we saw. And here's the funny thing. This isn't the first time we've watched this movie. It's a very similar pattern that has played out again and again over the last decade. Because go back to December 2018, stocks had been crashing for months on fears of a rate hike. Then Jerome Powell goes on stage and says one word: patient. And the Dow explodes. It was the first time the Dow had ever gained more than 1,000 points in a single trading session. Or we can go to August 2024, when the Bank of Japan hiked rates for the first time in 17 years. The yen carry trade began to unwind. Then the Nikkei drops 12% in a day, then bounces 10% the next. These are all different catalysts, but the same mechanisms. And the reason this keeps happening is that the structure of the stock market itself has changed. 20 years ago, the market was dominated by humans. Portfolio managers reading earnings reports, analysts modeling cash flows, people making discretionary decisions about what companies were actually worth. But now that market is basically gone. Today, 63% of all U.S. stock funds are now held by passive indexers. That's more than $13 trillion blind money. That doesn't read earnings reports or care if Apple had a good quarter. It just follows the index on autopilot. And because most passive funds are market cap weighted, the bigger a company gets, the more of it they buy, which is how the Magnificent Seven now makes up over 33% of the S&P 500. So a massive chunk of the market isn't being priced anymore. It's receiving allocation by default. And what's left of the active investing side? has also changed. The hedge fund industry has consolidated into a handful of giant multi-strategy funds, the Millenniums, the Citadels, and the .72s of the world. And their assets under management have grown exponentially over the last decade. These funds typically run at 4 to 8 times leverage, with strict drawdown rules, which means when they hit a drawdown limit, they don't sit in a conference room and debate whether the Fed is going to cut, or whether the war is really over. They sell immediately. And underneath all of this is the options market, because now, same-day expiration options make up around 63% of all S&P trading. On peak days, we're seeing over $2 trillion of notional value change hands in a single trading session. Every one of those options forces a dealer on the other side to hedge in real time, which leads to buying or selling the underlying stock to keep their books balanced. So the dominant players in 2026 aren't analyzing valuations or fundamentals. They're reacting, and when price moves, their reactions stack on top of each other. And this is what happened on April 8th. Once you understand this, once you understand the mechanics behind why markets are irrational, everything starts to make a little more sense. So, if you're tired of watching traditional financial media hand you the dumbed-down version of what's happening in markets, hit subscribe, because this is the stuff they conveniently forget to cover. Because the stock market we all used to know and love, the one about finding undervalued companies and investing in them for the long term, that stock market is gone. What's left is a giant feedback loop of algorithms, passive funds, and options dealers, all reacting to each other in real time. And the headlines? Well, they're just the narratives people use to help rationalize things.